right, let's get started. Welcome. Thanks for joining today. Happy Tuesday to those who celebrate. My name is Dan Kogan. I'm a consultant and an educator, and I've been partnering with Solventure for several months now on a few projects. And sincerely, one of the things that attracts me to Solventure is that it is really in their, I'll say, DNA to leverage innovative and what I'll call elegant frameworks. And I say elegant because they're so wonderfully simple. And they use these to distill complex problems into simple and practical solutions for their clients. And I think one domain where this is particularly apparent is their approach to competitive benchmarking, which appropriately they've rebranded and recast as strategic benchmarking. And clearly this is something that I'm personally excited about. And I want to thank Solventure for giving me the opportunity to share this with you today. So from an agenda perspective, here's what you can expect from today's webinar. I want to give you some context. We'll quickly cover the purpose of benchmarking and some shortcomings with traditional approaches in the marketplace today. We'll cover a concept. This is Solventure's approach from a theoretical perspective, and I want to ensure everybody has a baseline understanding. So we're going to use an abstract example at first. It's not complicated, but it is profound, and I think once I share it, you're going to get it right away. Yogi Berra had the quote, "In theory, there is no difference between theory and practice. In practice, there is." So I definitely want to take a moment to illustrate the application of the concept with a real world example to show you that, yes, it can actually be applied. And then on top of that, we have some more real world examples that you'll have access to and you can leverage for free as well. And finally, some discussion at the end. We have a lot to cover in just about 45 minutes, but I hope to have a few moments to hear your questions and comments at the end. By the way, you can go ahead and enter those questions or comments in the Q&A panel at any time, and I'll review those at the end. So let's dive into some context about the purpose and the landscape of benchmarking. To use an analogy, I like to think of benchmarking as a navigational device for organizations. So call it a GPS or a sat nav, depending on the geography in which you reside. Benchmarking is an exercise. It can be done at the start of a new strategic journey or really any point along the way when you kind of need to validate the course that your organization is on. And surely we've built up this webinar and you may be thinking of benchmarking as some grandiose thing. But if you're unfamiliar with it, all it is simply allowing organizations to plot their performance relative to their competitors and their industry peers. And what this does, and in turn, it helps them identify where they are and where they should be. In fact, when I think about benchmarking, it really should answer three questions. Where are we? Where do we want to be? And how do we get there? And it's actually all three of those questions are prerequisites to taking any further action on the benchmarking. It's not enough to simply know where you are, right? You need to choose your destination, and only then can you properly guide your organization to success. What we find in practice are some shortcomings, and it's quite simple and straightforward. A lot of benchmarks compare firms within groupings like sector or size, but without any regard for their respective strategy in the marketplace. And I want to provide a very simple, brief example of why this fallacy renders a benchmarking exercise basically meaningless. So let's consider the airline sector. And you may already see where I'm going with this, but it would be downright negligent for a premium provider like Emirates or Singapore Airlines to set its strategic course based on financial and operational performance metrics from a Ryanair or a Southwest airline, right? These are low-cost providers versus premium providers. So despite sharing the same sector, these airlines have very different value propositions, cultural DNA, and operating models, right? So we can start to provide some boundaries here and delineate strategies. Now, I'm not a football or soccer fan, but I think one of these is photoshopped. I don't think Ryanair sponsors near as many football teams as Emirates. But all joking aside, now that we've framed it this way, it seems all too obvious. So I promise there's more to the webinar than this. But I do want to take this opportunity to relay a true story of how an otherwise well-intentioned benchmarking exercise can set you on quite a misdirected course. And the example comes from Solventure. One of their clients is a premium consumer electronics manufacturer. And prior to engaging Solventure, they had gone through a traditional benchmarking exercise. And they were pleased with their gross margins relative to their competitors. Again, they were a higher end consumer electronics manufacturer. So they were definitely commanding a premium price, but they lagged their peers in working capital. In particular, they were comparing their inventory turns, and they were comparing them against somebody else on the benchmark report, which happened to be a low-cost contract manufacturer in Shenzhen, China. Okay. Now, when we think about this, we realize, yeah, the contract manufacturer is using lower cost components, and they're making lower commitments in terms of product availability and service, right? So this is naturally going to result in faster inventory turns. And if the premium brand had tried to match this, it could have been disastrous. I mean, I think about what they might have done to reduce their inventory and to try to increase inventory turns and lessen their working capital. They probably would have reduced safety stocks. It would have resulted in missed revenue opportunities and potentially damaged their brand value as a whole, right? And by the way, it's absolutely fine for the premium provider to maintain an inventory of more costly, higher spec components because they command a higher margin through their superior product. And we'll get into this in a little more detail in just a moment. Many of us travel, so the airline industry is something we can relate, but I also suspect that a lot of people on this webinar today are from a physical goods industry. So I wanted to include grocery as another example. Depending on your geography, maybe some of these brands are recognizable, but regardless, I think everyone will appreciate the concept. So if we consider a discount grocer like an Aldi or a Lidl versus a premium grocer like a Sprouts or a Fresh Market, at least in the US, Aldi and Lidl are going to have a relatively small footprint per store, right? And straight away, this could lead to less capital employed, right? They've got a smaller retail space, less physical infrastructure. But what it also reflects is the fact that the product assortment at Aldi and Lidl are smaller, right? You might choose between one or two brands for a specific good rather than 5 or 6 that you might see at another supermarket or grocer. And less intuitively, a narrow product assortment facilitates faster inventory turns. It avoids a long tail of slow-moving inventory by focusing on just a few goods that have faster turns. So it's actually this simplicity and operational excellence that is why the discounter is able to offer lower prices and operate on smaller margins. Conversely, you look at a Sprouts or a Fresh Market or any premium grocer, and these higher end grocers should experience the opposite of the conditions at Aldi and Lidl. They're going to command a higher margin either through higher end products. So think about organic produce or freshest seafood or something like this. And also by the convenience of serving as a one-stop shop for their customers, right? They're offering a broader assortment than Aldi and Lidl. And you can go to this one stop and pick up all the goods that you want. And that's a convenience that the consumer is theoretically willing to pay for. The takeaway of this slide is really that strategy is greater than sector. So even within sectors, airline, grocer, whatever it is, different strategies require different amounts of capital for physical infrastructure and inventory. And so straight away, we realize that we can't benchmark against a single metric like profitability in isolation. And this will tie into Solventure's approach. So let's take a look at that, at least in concept for now, and then we'll move on to application. So what's different about Solventure's approach? What they do is they advocate to benchmark in 2 dimensions simultaneously. And one of the dimensions reflects profitability. So you see the EBIT axis here. We'll talk about that in a moment. And the other reflects capital employed. Here we're using inventory turns as an example, clearly a subset of all capital employed, but just using this as an example. And the root of using these 2 dimensions connects to Solventure's supply chain triangle. You see that superimposed here on the left. And the supply chain triangle is used to balance the trade-offs of service cost and cash within an organization to maximize their financial return. And intuitively, this makes sense. We know that investors want to maximize their bang for buck, and firms seek to maximize the output of their profit over their investment, right? The details of the triangle are outside the scope of our session today. We won't have time to cover that in detail. Maybe we do another webinar soon. But I would encourage you to also check out Solventure's white paper, which is Balancing the Supply Chain Triangle. Definitely a worthwhile read there. So again, we have this abstract example over here, and we see EBIT, or if you're unfamiliar with that, that's the earnings before interest and taxes against inventory turns. And what we see here is that inventory turns are a subset of capital employed, but this same concept could be applied to a variety of metrics representing capital. We could use net property, plant, and equipment, or all of the capital employed, or any other combination. And the same thing goes for EBIT as well. We could change this to just be gross margin or some other profitability metric. So the idea here is that the main idea is that we have these two axes, one for profitability and one for capital employed, but we can indeed broaden or narrow the aperture of each axis to focus on what our analysis desires, or dissect our different layers of our organization. Okay, so the main thing is an axis for profitability and an axis for capital employed. A couple other practical takeaways when you're starting to do this type of analysis: you definitely want to normalize in the form of percentages, or like we've done, turns here, right? So EBIT should be represented as a percentage. Turns are naturally normalized. And it's also favorable to plot multiple years of history. Just in this example, we've plotted hypothetically 3 years. But the reason you want to do this is to ensure that you're avoiding any anomalies due to macroeconomic conditions or firm-specific challenges. And it also allows you to spot some inconsistencies and trends across the market or within competitors. And we'll actually see this in our applied example in just a few minutes. So the idea of including both a profitability metric and a capital employed metric is so that we can capture the trade-offs that are inherently embedded in a firm's strategic choices. And you don't have to look any further than the example shown in the table. So we can consider a product leader who commands a 20% operating margin or EBIT percentage versus a cost leader who only captures a 5% operating margin. Okay, significant difference there. But we see that they both have the same return on capital employed, or ROCE. Okay, and that's because the cost leader only uses a quarter of the capital employed compared to the product leader. Okay, so both can achieve the same financial return, provided that the inputs to the ratios allow them to do that, right? So let's talk about the math. We can't avoid it, at least on a conceptual level. So a metric like return on capital employed, again, simply the ratio of the EBIT over the capital employed, or any other ratio that takes a profitability measure over a capital measure from the balance sheet, will work for this. So think about from an investor perspective. It's not the numerator or denominator in isolation which matters, but the ratio as a whole. Okay, so just again, it doesn't matter if the firm's profitability is lower, provided that the capital required is also correspondingly lower. Conversely, a higher margin should allow for a higher capital employed. And we saw this in our grocery example, and we can assume it's the case for our airline example as well. Now, that may be obvious, but what this allows us to do is to use a metric like ROCE, or economic value added, or return on assets, or return on capital, or any metric which takes a profitability measure over a capital measure. It allows us to compare across sector, across scale, and across strategy. And remember, that was the shortcomings with the traditional benchmarking, is that we really couldn't compare across strategy. Now, how do we put that into practice? Since trade-offs exist between profitability and capital employed, how can we actually fairly compare across strategies? And for this, we'll take a note from our friends in economics. Economics provides us with this concept of an indifference curve, right? It sounds fancy, but again, it's just a ratio that preserves a constant output despite varied combinations of inputs, right? And economics traditionally uses this for substitute goods, but today, instead of comparing mangoes and oranges, we're going to see how we can derive a constant output by substituting profit for capital employed. And what we do in practice is we take a reference point. It could be the point of best performance by the leading firm. It could be a median or a weighted average among a few desired data points. And we apply some simple algebra. You could do it on your own. And it allows us to plot a line which traverses all of the inputs leading to that constant output. And you can see that both in the economics example here, but also in the EBIT versus inventory turns example. So it's a line which traverses all inputs leading to that constant output. And that's effectively a frontier of performance, which is indifferent to or actually normalizes across the strategies, right? It's normalizing across those trade-offs and therefore normalizing across those strategies. So we can mathematically substitute profitability for capital to arrive at a constant return on capital. But now we have to decide, where do we want to intersect the line? And that is not necessarily mathematically something that can be determined, right? It takes into consideration your strategy. But in reality, we find that we can actually reverse engineer strategy through publicly available financials. And we'll take a look at that now. So we still have our conceptual example up here. We've added a few annotations to it. So we have this single view of our firm's positioning relative to others in terms of both profitability and capital employed. And additionally, we have the line of best performance. And we've annotated these 3 circles for product leader, customer intimacy, and operational excellence. And I'll talk about that in just a moment. But where do we want to intersect the line? Let's say that we're a firm that's farther back from the line. It could either be firm 1 or firm 3. Firm 2 is on the line, at least for year 2. How do they get back there is a slightly different question. A line is not a point, right? So where on the line should our target be, and how are we going to get there? The ongoing theme here is that there's a trade-off between profitability and capital employed that depends on your strategy, right? Different firms require different capital for infrastructure and for inventory. So Solventure has mapped the trade-offs between profitability and capital to some highly regarded contemporary strategy models. And those are the strategy models of Tracy and Wiersema, who wrote The Discipline of Market Leaders, and Crawford and Matthews, who wrote the Myth of Excellence. And again, I would encourage you to refer to Solventure's white paper on balancing the supply chain triangle to learn a little bit more about both of those. But to summarize, in the most basic sense, are you more oriented towards product quality and innovation? Are you more oriented towards your customer experience, or are you more oriented towards low-cost solutions? And the answer to that question alone will act as a compass to set a directional strategy-specific target to those otherwise elusive questions. Where do we want to be, and how will we get there? That sounds abstract, but in practicality, it influences what organizational levers you're going to pull to get closer to that line of best performance. Are you going to increase inventory turns or asset turns, or are you going to increase your margin, just as an example? So let's look at an applied example. Here we've plotted the trailing 5 years of operating income percent and inventory turns for several toy manufacturers, Lego, Hasbro, and Tomy. And this is another industry where at least those who have kids can hopefully relate. But when we review the firms simultaneously on a 2-dimensional plot, the pattern is more apparent than if we just reviewed profitability and capital employed or inventory turns in isolation alone. We can already start to detect some patterns. It looks a lot like our abstract example. So Tomy is the darker blue down here at the lower right, and we can see that they have margins somewhere around 7%. And inventory turns have probably averaged around 6.5, but you can see they've definitely been on a slowing trend, right? So this is like an anomaly that you can see when you plot it this way, right? So something is going on with Tomy. Hasbro has a slightly higher operating margin, let's say averaging about 13%, but it does have slower turns, around 5 turns per year. And then Lego is quite distant, right? They're in the upper left with operating margins near 30%, but even slower turns around 4.5%. And if you know Lego's product portfolio, you might be able to take some guesses to why why they can command such a high profitability, but also why their inventory turns might be slower as well. But, you know, what does this arrangement really indicate? How can we make this actionable? And continuing with the analogy that we started with, the sat nav analogy, it's like we know where we are, but we haven't entered the destination yet, so we don't know how to calculate a route. But if we add our indifference curve, and in this case we used a line of best performance that's based on Lego's 2021 performance, so you can see it intersects there. Some simple algebra would allow you to calculate this. Now we have a target, right? But again, a line is not a point, right? So ultimately, regardless of strategy, it's desirable to be on this line of best performance. But where would Tomy or Hasbro, for that matter, want to intersect this line? And we could simply say that because output is identical or indifferent, where we want to be on the curve is moot. But the inputs themselves, as we know now, are highly dependent on our broader strategy. So in our sat nav analogy, we now need to calculate the route. And it's not necessarily about the quickest path to the line, right? So just as an example here, if we're doing this for Hasbro, which is the middle one here, do we just go, I'll call it due north, right? And try to increase our EBIT, our profitability, either by lowering our costs, our direct cost, our cost of goods sold. Maybe we are able to raise our prices and we weren't realizing that. Maybe we need to lower some overhead like sales, general and administrative costs, right? And we could dive into that by changing what this axis represents. Do we go, I'll call it due east, right? And try to increase our inventory turns. Based on the graph here, we didn't extrapolate far enough, but it looks like that's going to be a challenge. But we could, again, broaden the aperture here and look at overall capital employed instead of just inventory turns. Maybe we've got some idle assets that we need to divest, right? Or is it some combination of these two, right? Are we going to try to increase our profitability and lower our capital employed, right? So we need to calculate our route. It's something that we're going to want to explore, right? But how do we begin this exploration? At the beginning of the webinar, we spoke about how different strategies can lead to the same ROCE, or return on capital employed. And again, through the magic of simple algebra, we've turned that logic inside out here to calculate a Cartesian product of all the possible ROCE inputs, right? And this one is based on Hasbro. I just took a delta from their current capital employed. But what this approach allows us to do is to simulate the impact of combinations of more specific levers, right? So we could make an Excel model that decreases the capital employed by, reducing fixed assets or extending payable terms, or simulates profitability increases by reducing the cost of goods sold, or selling costs, or adding price increases, something like that, or any combination thereof, right? And this allows us to test various reasonable assumptions to try to achieve a maximized return on capital employed, right? So one of the things is that these numbers are readily available for publicly traded companies. You could use Morningstar or Yahoo Finance, Excel with some basic math, and you could achieve the same thing that we've done here, right? And I just want you to take for a moment, go ahead and imagine the power of delivering this analysis with a few scenarios to your company's C-suite, or to your clients, or to your prospect, right? It's all within your graphs. The numbers are available publicly, at least for publicly held companies, right? So imagine this to war game your competition's next move, right? In our experience, this is a fantastic analysis to not only evaluate strategy, but also to communicate and activate it. And that's because the metrics here aren't purely financial, they relate directly to operational metrics as well. Again, it's very clear that you can impact this through your working capital, with your payment terms, with your inventory, and with your capital infrastructure as well. if this is interesting to you and you want a few more examples other than the toy manufacturer that I've given here, or you want to give it a test for your industry, there's a website, strategydrivensupplychain.com, and it has a resource section. And there's a number of different types of resources there, but one of them is benchmark reports. And I think there's probably 3 or 4 dozen public companies across multiple sectors there. And these are interactive, right? You can select which companies you want to show and which ones you want to calculate an indifference curve from, right? Again, this is there for you to explore. Maybe your company or your industry is there and it could be valuable. If you want help performing or interpreting this type of analysis, it is indeed a service that Solventure or the Strategy Driven Supply Chain Institute can provide to your organization. So again, these are free resources. They're out there. I'd encourage you to check them out. In the end, there's a lot of loose definitions for strategy, and that's one of the reasons companies struggle with it so much. It's not this hard discipline that we can really give a single prescriptive path for, right? But in the essence, everything that all the definitions of strategy are bound together with this need to make choices. And yeah, Michael Porter told us, without trade-offs, there would be no need for choice and thus no need for strategy. And to me, when I look at Solventure, that's at the core of their approach, right? They recognize that the presence of trade-offs associated with strategy, and they've incorporated them into the benchmarking through 2-dimensional benchmarking, through indifference curves, and the link to strategy models as well. And they've done it in a way that's quantitative, but it's intuitive, and it's practical in that you can simulate the impact of specific operational metrics or operational levers on a firm's financial performance. So it really does help you answer those questions that we started off with. Where am I? Where do I want to be? And how do I get there? So at this point, I'd like to open it up for any questions or comments. Let me stop sharing and I'll take a look at the Q&A board. Okay, so I see one. You used inventory turns in a lot of your examples. How does this hold with other metrics reflecting capital or cash? Okay, yeah, it's a great question. I use inventory turns for a couple of reasons. One, I'm a supply chain guy, and 2, because higher inventory turns are favorable. So that makes the curve in the graph a little more intuitive to newcomers for this concept. But the truth is that this concept holds with any metric reflecting capital employed or a subset thereof. The key is to use a profitability measure on one axis and a capital employed metric on the other. And again, I mentioned it, but you can broaden or narrow your aperture of each axis as desired for your analysis, right? In fact, that's actually a great thing about the examples on that website. Once you have a database created, and again, it's relatively easy to pull this data from Morningstar or Yahoo Finance, you can easily replicate the analysis across a variety of measures and look at them simultaneously on a dashboard. And if you go to the strategydrivensupplychain.com, they have a nice dashboard which shows, I think it has EBIT versus net property, plant, and equipment, EBIT versus cash conversion cycle, fixed assets, several different layouts. So you can look at them all simultaneously. And again, it is different depending on what industry you're in, but when you look at it across a couple of different metrics, you can really quickly dissect the different layers of the business model. And again, the nice thing about all of the capital metrics is that they're actionable from an operations perspective. It's not about adjusting your capital structure, your financing, or your tax strategy. It's about changing your footprint from an infrastructure standpoint. It's about managing your inventory or managing your payment terms. And these are all actionable things from an operations perspective. There's another question about private companies. Yeah, it definitely gets a little more challenging with private companies, right? First, I would say if your firm or your client's firm is the private company, you should still be able to collect this data and compare it against other public companies if that's applicable for your situation. If your competitors are private, it gets a little more challenging and a little murkier. Maybe two suggestions. The first would be sometimes even private companies provide some reporting. So actually in the example today, I used Lego, which is a private company, but they still publish an annual report, and I was able to pull the information from them. And depending on the openness of the private company and maybe even some local reporting requirements, you may be able to get enough data to perform this type of benchmarking with a private company, or at least make some interpolations or estimations. Also, depending on your sector and your size, don't neglect it. A lot of private companies have kind of oscillated in history between being public and private. So you may be able to collect some data before private equity came into play, right? And even though it may be a few years old, you might be able to kind of extrapolate that with some trends into the future. And that at least serves as a baseline. All right. Well, I hope you enjoyed the webinar today. Again, this will be followed up by a more detailed white paper. And please don't hesitate to reach out if you have any questions at all. Thank you.